In this video, we're going to be going over decoding fair value gaps with order flow. So again, it's a triple X model, which I talk about, and we're going to be understanding how you can use order flow to trade all the fair value gaps. So we're going to be dissecting every fair value gap, give you sniper precision and entries so you know exactly whether the buyers or the sellers are in control, because ultimately as traders, no matter how you trade, you want to be on the right side of buying and you want to be on the right side of selling. So this is how you can find supply and demand zones or bullish and bearish key levels using fair value gaps and order flow. So to kick things off, my triple X model, so I go through this every time. I'm going to quickly go through it. So the triple X model, simple trading is profitable trading, right? So you need to know where to trade from, what to look for, and why you're looking for it. So a key level needs to have an entry in the key level, and you use order flow to determine whether you want to go long or short. And so another way to look at this is you need a fair value gap, 1 to 2 fair value gaps per day. You want to look for a break to the up or downside from that fair value gap, and you look for a retest entry to go long or short with order flow. So again, we want to start every single trading session with a pre-market plan. So this was the 6th of October. So this is now basically 9 a.m. Eastern or 2 p.m. UK time. And we're looking at S&P 500 futures. Now, specifically, we're looking at ES futures, and we want to understand where our key levels are. And so if I just bring the charts up now, we're going to be understanding where this key level essentially was, right? So ES on the 15-minute time frame, this is what we're going to be breaking down, right? So coming into the pre-market session, right? This is what we're looking for, right? So the pre-market session, we had this 15-minute fair value gap just over here, right? So this was the 15-minute fair value gap. I'm going to zoom in so everyone can see this. So we always mark the candle before the fair value gap. So we're only looking for 1, maximum 2 fair value gaps per day to trade from, right? And so it's the same here, candle before the fair value gap. And we did have a fair value gap down here in a key level from last week. So these are my key levels, right? So notice how I have my key levels marked out before the session even starts, right? This will eliminate 90% of your losses. So a pre-market plan. So on ES, my pre-market plan is very simple, right? So you can see the levels resting over here. So 67.83 down to about 67.81, 67.80. Now, if we break below this level, this will be a supply area. I want to look for a short, which I didn't actually take, right? But we're going to be breaking down the trades I took, right? So this was the first trade I took at 10 a.m. Eastern, right? So I'm just going to break down this trade, right? So my entry was at 60, as you can see, 67.69, stop just above this level at 67.74, and I was targeting roughly a 1.5 or 1.6, 1.8 R risk to reward. Now, this trade didn't work out the way I wanted it to work out, right? So this is going to be the lesson for all traders, right? So this was the key level I actually shorted from. It wasn't this one. It wasn't this one. It was this one. So if we just go back down to if you get rid of that, so the first short I took was this one down here, right? So I shorted here. So as you can see over here, so the red line represents where I exited. So we're going to be breaking this trade down regardless of the setup, right? Sorry, regardless of the outcome, the setup is worth understanding. So we came into a key level, right? And my entry, as you can see from this slideshow, was 67.69. And so why was this a valid setup? So the first trade around 10 a.m. Eastern. So what we can see, if I just zoom into this, right, what we can see here is we can see a lot of aggressive buyers, right? Particularly, we see a lot of aggressive buyers here. We see a lot of aggressive buyers over here. And then we see a big break to the downside. So as a trader, you want to understand that every single key level you trade, every single entry that you take must be validated with order flow for it to be valid, right? It has to be validated with order flow. So what we can see is we can see a big break. Notice how we have high volume over here. The volume increases as the market moves down, and we had 37 for 114. So this was my indication to go short at this level. So notice how we had a break, and now we're looking for a retest. And so the retest was even more interesting, right? So the retest, I know the numbers are a bit small. It says 89 for 212, 0 for 67, 124 for 214, 111 for 220. So we can see a lot of blue delta inside the candle, right? So quick masterclass on order flow. The delta is the right number minus the left number. The right number is the aggressive buyers and the left number is the aggressive sellers. So what we're seeing over here is we're seeing a lot of aggressive buyers unable to sustain higher prices. We break below. This is my first entry, then we break below again. So this is my second entry. So I went in with 11 contracts on MES, risking about 270 to make about 410. Okay, so how did this trade pan out in the end? So what happened was I entered roughly here, and when price broke above the key level with a body, I took my loss. So it wasn't a full 1 hour loss. It was about 0.4, 0.5 hour loss. So I will gladly take that loss, right? So the reason I'm going to gladly take that loss, so if we just break this down, is this. So if we just really break this down one more time, what made me go short, right? So let's bring up the PowerPoint, right? So I can see aggressive buyers in this candle, right? So these aggressive buyers were not rewarded, right? So I'm just going to write 37 for 114. That corresponds to this region, right? So we saw a lot of positive delta and a break below the level, right? We break below this level over here. So if I continue to drive price, if I continue to play price on, what we saw is we saw a second break below this level, right? So we saw a second break and I was comfortable to go short just over here, right? This was my short over here, right here. So I was comfortable to go short. Now, the reason I was comfortable to go short one more time, and I was trying to get basically a 1.5 hour risk to reward. The reason why I was comfortable to go short is because I saw aggressive buyers failing to break above this level, right? We broke below this level. So as you know, when aggressive buyers fail, that means that passive sellers are in control, right? This is a supply area, right? This is why I took the short at 10 a.m. Eastern. Right, so sorry, 10:10 Eastern, right? So aggressive buyers fail, which shows you that there's sell limit orders resting in this region. So the lesson I took away from this, right? So as you can see, we had a quick bounce up and then eventually it would have stopped me out here. So what was perhaps wrong with this trade, not from an order flow perspective, but from a key level perspective? What could I have done to improve, right? What would the Twitter warriors tell me to do to improve here? So the lesson here is daily PO3. So take a look at where I shorted, right? So I attempted to short from this level. However, the daily opening price was all the way up here. So we're way below the daily opening candle, right? Sorry, the daily opening price. And so for those who trade ICT or just generally understand how the daily cycle works, the markets will move up to go down, right? So the markets will move up and down, and the manipulations, the high of the days, the high and low of the day will occur. So you don't want to be shorting when you're near the low of the day. Now, of course, there's an argument that I don't know where the low of the day is going to form, but the lower down you go below the daily opening price, the lower probability your short setups become. In fact, what happened, this was the low of the day, so I caught the low of the day and I shorted at the low of the day, which wasn't an optimal key level, right? The key level was valid, but it wasn't an A+ key level. And that is why I took the 0.4, 0.5 hour loss. And I'm happy to take that loss if I understand next time not to short below the daily opening price. Now the long. So the long came at probably 11:30, 11:26 Eastern. So this trade here was quite interesting. So if we just go to the charts now and we go back and kind of analyze what was going on, this was the trade itself, right? So what you'll find is we had to really patiently wait for this to play out, right? So here we are. So before I go and break this trade down, I want all the traders to understand that this key level was the same key level I planned at 9 a.m. Eastern. So we tap into this at 11 a.m. Eastern. So it's about a 2-hour wait, right? So this is the key level we're looking for. Again, quickly, let's break down what a key level is. 15-minute fair value gap. We are looking to take the market long, the market short, the market long at this key level. So the lesson here is you don't know whether the key level is a demand zone or a supply zone unless you validate it with order flow, right? So let's go to the 1 minute chart now. So on the 1 minute chart, we tap into this level around 11 a.m. Eastern, and what we're seeing is we're seeing a range, but understanding this range is super duper important because, you know, I was, in my younger self, I would have gone short here, taken another loss, or I would have gone long here, taken a break even. The question is, how can you capitalize on these moves, right? So you've got to understand a couple of things. So let's go back to the PowerPoint. Now, a key level, the way that a key level forms is it can either be supply or it can be demand, right? It can be supply or it can be demand. So here, without even looking at the order flow, we can see a heavy wicks and there were aggressive buyers in this region, right? So these aggressive buyers have driven price down, right? This was an area of supply. This was an area of supply. So how does a supply form? A supply forms like this. So we see aggressive buyers hitting the ask, right? So we see a lot of blue delta, positive delta, right? We do not see these buyers being rewarded, and that's why we break below the level. So again, if I bring the Discord up, right, what we had at this key level was this. So if I just bring this up, we see price breaking below this level, right? So this key level over here, this top key level, held as supply. And the reason it held as supply is because, as you can see, there's a lot of aggressive buyers sitting over here. I'm just going to read out a few numbers. So 0 for 47. 47 aggressive buyers, right? Hitting the ask, the right hand number, right? 47 is obviously bigger than 0. That means that there's 47 market buyers, 47 aggressive buyers. Likewise, here's 0 for 30. 30 aggressive buyers, 0 aggressive sellers, right? Just like here, 188 for 285, we see a lot of blue delta inside of the candle. So we break below the zone, we have aggressive buyers failing, which actually means the buyers have been trapped, right? The buyers have been absorbed. Who have they been absorbed by? So the way that any supply works, right? The way that any supply works is you have a lot of aggressive buyers at the top of the zone, but the market is continuing to give lower lows, right? The market is continuing to break lower despite having aggressive buyers over here. That's why I put a blue box over here, right? Positive delta, positive delta, positive delta. All that means is the ask is greater than the bid. So for those who have basic order flow understanding, the ask is the right-hand number. So the ask is a lot bigger than the bid. And that is what we see in this image, right? We see a lot of blue delta, 222 for 322. So again, we see positive delta, no reward, right? Even over here, this rejection candle, super interesting. The candle itself was a doji, hence why we see a gray body. We have a lot of buyers over here, 131 for 225. So we had a rejection lower. So what this shows us is that supply was in control because these aggressive market buyers failed. So if we just take a look at this, this was roughly 67.80. I'm just going to say 67.82. So roughly 67.82.83. This was an area of supply. Sellers were in control. It was an area of supply. The aggressive buyers were absorbed. They were trapped. They were not rewarded. They didn't have follow through. Lots of ways to say, but a very simple way to understand this is that sellers enter the zone, aggressive buyers fail, passive sell limit orders are present, price drives down. This is a supply zone. Simple to understand. Now, when it comes to a demand zone, price comes back into the area and we see price flipping from supply to demand, right? So this is now the opposite. So the same principle applies. The only thing here is the bid and the ask have swapped. So think about it from a pure logical perspective, right? If this zone breaks to the upside, right, the sellers over here, those passive sellers that were responsible for driving price down earlier in the session, have failed. And they failed very simply because we've broken above the level. So going back to XXX, it's the same level every single time, right? It's the same every day. You approach the markets by looking at one level. It can either hold a supply or demand. Your job is to use order flow at these fair value gaps to decode what is going on. So if you just take a look at demand over here, what was interesting now, so if we just play through the session, this is my short, took a small loss over here, and then the long came here. So the long, we're going to break down this long. So this long here was 67.84, stopped just below 67.81, so about 3 points worth of risk. and probably about 11 points of reward. And this trade I managed horribly, and I think I closed it at only a 1R. So I basically made up for the loss I took earlier in the short. So break even session, but the trades itself, the long trade, super good setup. In my opinion, probably the best setup. So probably the best long setup in a while, in my opinion. So this, again, obviously this long setup, I was up probably about $500 at one point. Again, moving my stop loss to break even or trailing it to allow markets to run up to the next fair value gap. So notice how the trading itself is key level, entry, order flow, fair value gap, entry, break and retest, or key level, entry, order flow. It's 3 simple steps of where, what, and why every single day. No exceptions. So if we take a look at the entry here, I'm just going to break down why this zone actually held, right? So this is the main reason, right? So we're going to be breaking this down. So when we have an area, when we have this kind of price action, again, if we go back to the charts, when we have this kind of price action, so we're going to go to the 1 minute, right? So what we can see here, candle by candle, if we break this down, this is what we're going to be focusing on. So we had this red candle to the downside. Then we notice how we're peaking above, right? So we peaked above. So the way that I like to trade break and retest is like this. I want to see price come into the level. Oh, let me draw that again. So for me, the way I like to trade break and retest, I want to see price enter the level. This is step 1. I want to see price breaking above the breaking above the level with a candle closure. This is very important, right? Because a lot of people, even me in my old days, I would have gone short over here. There's a fair value gap. I would have entered off the fair value gap, stop loss below here, and I would have I would have taken a loss and I would have been confused, right? So if you're taking losses like this, it's because you didn't understand fundamentally what was going on here, right? So this is what I'm going to be going through. This is the main reason the market moved up today, right? So in fact, I'm going to bring them next to each other, right? So this is an unnecessary loss to take, and the reason you take it is because you're not using order flow at key levels, right? So let's break this down. What you can see here, 117 for 0, and this is such a dark number, I think it's 250 for 180, right? It's a very large negative delta, right? So what's going on here is we see a ton of aggressive sellers, right? 117 for 0, right? What does that mean? There's 117 market participants going in aggressively to sell. They want to drive price down, right? So there was a ton of sellers resting over here, and even with previous price action, we see 299 for 66, 73 for 0. We see a lot of this negative delta below the zone. The question now becomes, were these sellers actually successful, right? Because every time we have a spike of aggressive sellers, especially here, we seem to be moving up, up, up. So were the aggressive sellers successful? The answer is no. Okay, so this shows us that buyers have to be in control, right? So how would I approach this, right? Where would my entry be? Because I get questioned about this, right? So for me, an entry would be officially, you can either enter here like this, or an even safer entry would be here. So my entry for this particular trade, if I bring it up, was 67.84. 67.84 was my entry, right? So let's just put that here. So 67.84, right? Stop loss below the zone. And as a trader, you don't want to be greedy. You just target the next level, right? That's all you look to do. So obviously you want to let the trade run. There you go. Now, one thing to finish up on is notice how we had multiple entries into this area, right? So what happened here also happened here, right? So we had aggressive sellers over here. We also had aggressive sellers over here. So the thing I want you to understand is that in this region, there were a ton of aggressive sellers, but they were not rewarded. So if you see aggressive sellers hitting the bid, constantly hitting the bid, and they're unable to sustain lower prices, this means that buyers are in control. Passive buyers are in control. And this is the reason the market moves up in the first place, right? So I'm going to finish off just by just making you understand the difference between supply and demand, right? So if we go to the 5 minute, what we had at the start of the session was the zone. The zone itself was holding as supply because aggressive sellers were in control. Now, when we came here, these same aggressive sellers failed, And over here, these passive sellers from the start of the session around 9:35 also failed. So if passive sellers fail and aggressive sellers fail, your only option is to buy. All right, so that's how the long was taken, right? So just to quickly go over my terrible management for the session, I should have closed at 2R because my rules say once we get to 2R or even 2.5R, I need to take profits off the table because the S&P often reverses, and it did reverse on me. So I actually closed this trade. I wanted to hit here. I closed the trade here for roughly a 0.8. So it wasn't even a full R. I closed here. Very sad about that. But again, detaching the outcome from the trade itself is important. So the trade itself was a very good trade, right? It was the best trade. It's what we call a flip zone, right? Price flipped from supply to demand, right? And the only way we can see that, I'm going to finish here, is by understanding this this price action over here. Aggressive sellers fail. This means that passive buyers are in control, right? So again, this is a flip zone. Supply flips to demand. So just a quick summary about what we went through today, just to sum things up. So decoding fair value gaps, right? So hopefully what you've learned from this video is the long and the short, both of them come down to the same principle of one key level, patiently waiting for an entry, and then going long or short based off what the order flow tells you, right? Not anything else, not sweeps, not breaks, not liquidity sweeps, not fair value gaps, inverse fair value gaps, nothing, right? None of them have any substance unless you understand the true meaning of buyers and sellers, true market dynamics behind every candle, every long and short. So again, a triple X model, where, what, why? It's triple X because it's got three things. Once you define your key level, pre-market, that's important. Wait for an entry at this level. So if you have a level here where this pen is and you have a level here, let's say you're trading in here, that means you don't trade, right? Because price will always gravitate towards supply and demand areas, and it's your job to use the order flow to actually determine whether you want to be buying, i.e. is it a demand zone, or selling, is it a supply zone? Now, again, a pre-market plan. Pre-market plans are the easiest thing to do, but yet it's the most underrated thing. Have a key level, have a 15-minute fair value gap. It should be above or below the daily opening price. Don't get caught up in trading way below the daily opening price. Don't get caught up in choppy markets, right? Have a key level, stick to that key level, maximum 2 losses per day at that key level. Again, the short. Quickly going over this, right? We had aggressive buyers here, aggressive buyers fail, aggressive buyers fail. Valid short, way below the daily opening price, could have avoided taking the loss. The lesson here, right? This was the short, so took a small loss over here. We're way below the daily opening price. So this means that the low of the day is anticipated, right? If we're way below the daily opening price, the low of the day is anticipated, right? So selling near the low of the day, or just generally selling way below the daily opening price, isn't necessarily the best thing to do. Now, the long basically came because supply switched to demand, right? So at the start of the session, 9:30 to about 10 a.m. Eastern, a lot of aggressive buyers over here failed. So we had sellers in control. Sellers were in control. It was a supply zone. Supply means sellers are in control. Now, at a demand zone, the opposite happens. So when we break above the key level, this supply then starts to become a demand. And the way you know it's a demand is by looking at this, right? So aggressive buyers fail, it's a supply zone. Now, if we break above this area, we see supply starting to fail, i.e. demand is kicking in, buyers are kicking in. So the final thing I want to leave you with is understanding aggressive sellers. When they fail to break below a zone, these aggressive sellers will be absorbed, right? So when you see aggressive sellers, right, it's like support and resistance, right? This is a true support. It's a support. It's like a ceiling because you see a lot of selling pressure, aggressive sellers, but you don't see any follow through. So imagine you have a ceiling like this, right? And you see a ton of aggressive sellers, right? If this level doesn't break, it shows you it's a strong area of demand, strong area of support. It shows you it's a strong fair value gap, right? We've decoded the fair value gap to understand exactly who is in control between the buyers and the sellers.